Hey everybody, Smart Silver Stacker here. Hope you're doing well. Markets are becoming incredibly chaotic and the economy is not nearly as strong as we have been told. In fact, we are being set up for a collapse type event, which is going to have a huge impact on the precious metals, both gold and silver. Right now, markets are completely detached from reality. They're no longer responding to any sort of fundamentals. All that we're witnessing is markets reacting to headlines, tweets, and political theater. This is playing out before our very eyes. One day we've got Donald Trump threatening to fire Jerome Powell. The next day we've got vague promises of progress with China, followed by flat-out denials. The whole thing is chaos. Meanwhile, the economy is quietly deteriorating before our eyes. We've got weak GDP numbers, mass layoffs being announced. And underneath all of this is something even more dangerous. It's that this time, when the Fed intervenes to bail out this ramshackle economy and they return to money printing, and that's what's being set up here, the rest of the world is not going to soak up the excess like they did back in 2008 or 2020. Right now, we've got de-dollarization in full swing. And that means that inflation is going to hit faster, harder, and more globally than ever before. Now, gold has already broken out of a decade-long consolidation. It's been crushing record all-time highs, and it's already a barometer for the chaos that we are experiencing. But silver is coiling inside of a 40-year cup and handle formation. And when this breaks, it's going to run fast and it is going to run hard. This is a moment to pay attention because when the pivot comes, it's not going to wait for anybody to catch up. So let's get to it. Buy your gold and silver at SD Bullion. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Okay, so to start things off today, I guess we should just touch briefly on what's happening in the markets today, which is a sell-off across asset classes. You've got copper down over 5% right now. U.S. stocks are in the red across the board, although they are off the lows of the day. You've also got oil getting hit big here today. Gold and silver are slightly down. Silver down less than 1%. Gold is down less than half of 1%, and it's still over $3,300. But the name of the game today is selling, and this is the result of fears of a broad-based economic slowdown, which have been stoked by a weak U.S. GDP report that was released earlier today. And we'll delve into that in just a moment. But I want to look at this long-term chart of gold, and then we'll take a look at the long-term chart of the silver price as well. So this chart goes back to 2011 when the gold price was touching just under 2,000, which at the time was a nominal high for the gold price. And then we had this long consolidation, which formed the cup of this cup and handle formation. So gold was consolidating for more than a decade. We had the handle here where the gold price touched 2,000 or just over 2,000 about 4 times. 1, 2, 3, 4 times before we got that breakout in March of 2024 when the gold price just began to rip higher to new record all-time highs. It recently touched $3,500, although it has corrected back slightly from that level. And I do view this as kind of a buy the dip opportunity in gold. I don't think we're going to see sub $3,000 gold maybe ever again. If you thought you had missed out when it was hitting $3,500, maybe there's an opportunity here to get in. Not financial advice, of course. And also, I just want to mention, for those of you who think that even with the pullback in gold, $3,300 is just too expensive to stack. I mean, me personally, I am usually stacking in increments significantly less than $3,300. You can always buy goldbacks. You can pick up 1/2 goldback note over at SD Bullion right now for $3.27, and that is 24 karat gold. Each note is 1/2000th of a troy ounce. So really, anybody who is doing any amount of stacking can still get exposure to physical gold via the goldback, something to consider. And yeah, I'm aware there's a premium on them. They are orders of magnitude more fractional than other bullion products. And if you've seen my other videos where I talk about the premiums, you'll know why that's not something that really concerns me, because the spreads on goldbacks are very tight. I'm not going to get into it in detail here, but check out those videos. I know people are rushing to their keyboards to comment about the premiums. But let's get back to the charts here. So this chart shows you just what a bullish pattern this cup and handle formation can be, as evidenced by gold's rapid rise following its breakout last year. Now, going to the long-term silver chart, we got to zoom out a bit more for this one because there is a similar pattern forming in silver, which dates back even further, going all the way back to the 1980 highs in silver when the silver price hit $50, which of course was, a lot more valuable back then. If you talk about it in today's dollars, that's like having silver over $200 when you adjust it for inflation, even just using the CPI. But there is a similar cup and handle formation on the long-term chart of silver to the one that we see in gold, where we had that major breakout. Now, silver really to break out from this one would need to rise above $50, but based on what we are seeing in the markets and the economy, there is a real possibility that we could end up seeing that, maybe not, next week or tomorrow, but in the relatively short term. And it all has to do with the Federal Reserve and what is going to happen to the dollar here. Now, let's take a look at the chart of the NASDAQ here, because I want to illustrate just how volatile and crazy things have become over the past month or so. Here is April 2nd. That was Liberation Day, when the current trade war and tariff war really accelerated and entered its current form of maximum uncertainty driving these markets. And if you zoom this out to a one-year chart, you can see, just the marked difference following that date. Sure, there have been ups and downs up until this point, but now just look how choppy things have become. And this is based on nothing more than tweets, headlines, political theaters. The fundamentals are not what is driving this volatility. And I want to give you some examples here. Here's a story from AP from April 17th when Donald Trump was discussing how he was not happy with current Fed Chair Powell. And the quote was, "If I want him out, he'll be out of there real fast. Believe me, I'm not happy with him." And this seemed to concern markets somewhat, raising uncertainty. We're wondering, are we going to get some kind of politicized Fed? Is there going to be some executive order used to change the way monetary policy is determined? And then what did we get just a few days later? Donald Trump says he has no intention of firing Federal Reserve Chair. The quote was, "I have no intention of firing him." And, markets liked this, right? This was almost like one of those headlines designed to goose markets. And it seems like a lot of these developments and a lot of these statements coming out of this administration are designed to do exactly that. They're just designed to goose the markets, feed the markets something that they like, give the algorithm something to boost stock prices on. And these are treated as PR victories. I mean, we had that one incident where Donald Trump rolled back the reciprocal tariffs, or he paused them for 90 days, and you saw that massive run up in the stock market. And then he was taking credit for that a few days later, saying this is one of the biggest rallies ever. And of course, he's ignoring completely the fact that it was a rally following a massive crash predicated on something he had announced. So these are not the signs of a healthy market, this kind of volatility and chasing headlines like this. You got recently Commerce Secretary Lutnick telling us that he's got a trade deal done, but he can't name the country because they're waiting for approval from the country. Okay, yeah, I mean, this is just an example of these kind of headlines designed to give the markets something positive to rally on, whereas as far as I can tell, nothing has fundamentally changed here. Back on April 23rd, Donald Trump telling us that China tariffs will come down substantially, telling us that he's in negotiations with China and he's going to treat them very nicely. Then the following day, you've got China denies any suggestion it is currently in talks with the U.S. over tariffs. So again, I mean, the picture here is basically as clear as mud as to what is actually happening behind the scenes. And the markets are just whipsawing on every tweet, every headline, and every unsubstantiated claim coming out of the administration or from these foreign leaders. 2 days ago, on Monday, April 28th, we once again had China insisting that there are no tariff talks underway, despite what the U.S. is claiming. So who knows what is actually occurring here with this trade war? The only thing that is certain is more uncertainty. And also, there have been these exemptions, right? So we already saw what happened following April 2nd, the announcement of those reciprocal tariffs on countries around the world. You saw stock markets here in the U.S. plummeting, kind of revealed that the U.S. is in no position to declare a trade war on the rest of the world. And we have one of the most vulnerable, leveraged economies around. Of course, the whole world is basically in the same boat, but now we've got all these talks of exemptions, right? Initially, the tariffs on China were going to cover everything, these 145% tariffs. But then I guess the administration realized that that would bankrupt U.S. companies like Apple. So a number of things had to be exempted, including phones, computers, and chips. Yesterday, we got another announcement from the administration of sort of this backpedaling on tariffs, giving automakers relief by not stacking tariffs on raw materials along with parts, so they just pay whichever tariff is higher, and they may even potentially be reimbursed for tariffs that they have already paid. There's just so much flip-flopping, there's lack of concrete information, and the markets are in this constant state of flux as a result of this uncertainty. And on any hint of good news, you see the markets getting bid back up as likely retail investors flood in and start buying the dips. And it's very possible that that retail crowd could be getting set up here as bag holders as we head towards a bigger collapse. Now, we've been told that we have this incredibly strong economy and we're winning everything and we're headed towards victory here in this economic war. But today's GDP report seems to conflict with that narrative. And this may just be the beginning, the real cracks starting to show in how weak the U.S. economy is here and how unequipped we are to deal with the trade war. The U.S. economy shrank 0.3% on an annualized basis. That's the first quarter numbers. And as this article from CNBC points out, the report provided cross signals for the Fed. While negative growth numbers might push the central bank to consider lowering interest rates, inflation readings could give policymakers pause. And what we're heading for here is stagflation. That is the scenario that we could very well find ourselves in. This is typically very bullish for precious metals, similar to what we witnessed in the 1970s, except this time it is going to be on steroids. We'll talk about why in just a moment. However, I want to get into a few more of these signs of just how weak and hollowed out the U.S. economy really is. And while markets remain in bubble territories and are grasping at straws to remain there, everyday Americans are really feeling the pinch. There was a survey released by LendingTree, which found that 25% of buy now, pay later users are now funding groceries with this form of credit. That's up 14% from last year. The survey also said that 41% of respondents said that they made a late payment on one of these loans. That's up 34% from the year prior. This is just another sign of how the American consumer, which is the linchpin of the whole system, is coming under pressure from rising inflation that remains elevated. Even if the pace of debasement has slowed temporarily, largely due to lower energy prices, there has still been no relief from the massive inflation that we've experienced over the past 5 years, regardless of what you hear from the administration. The president says there's no inflation and that Powell should be cutting rates, but the reality is that just the basic costs of living are now so elevated that Americans are having to use buy now, pay later loans to purchase their groceries. And anybody who goes shopping for groceries or who buys anything these days knows that inflation remains a significant problem. That is likely why U.S. consumer confidence has plummeted to COVID-era lows. The Consumer Confidence Index from the Conference Board in a report released yesterday fell to 86. That is the lowest reading since May of 2020. We've also got mass layoffs being announced here in logistics. You've got UPS cutting 20,000 jobs, and you can expect to see more of this as the economy continues to weaken in the face of both the trade war and the unsustainable nature of this economy, this debt-addicted economy. I mean, Trump is right. We do need lower rates. We do need more borrowing to be stimulated, and that's because the whole system is dependent on that. The problem is that ultimately that is an unsustainable path that will lead us to an economic crisis and the destruction of the dollar. Got the U.S. national debt here continuing to climb, now pushing $37 trillion. Here's the latest Treasury report, which reveals that last month the deficit was $161 billion. If you annualize that number, it gives you an annual deficit just shy of $2 trillion. So don't be fooled. The debasement and borrowing continues. Now, here's the reason that this is going to be such a problem, though. This is a chart of the Fed's balance sheet, okay? And you see in 2008 what they did to bail us out of the great financial crisis. They borrowed a huge amount of money. The Treasury borrowed the money. They sold it to the Fed. The Fed bought up tons of U.S. debt, put it on their balance sheet. They continued this for close to a decade. They tried to taper the balance sheet, and whoops, what happened? We had a crisis. We had the overnight lending facility crisis back in 2019. Fed had to start buying debt again. Then conveniently, we had the COVID lockdowns and the COVID crisis where the Fed purchased trillions and trillions of dollars up until 2022 when the Fed balance sheet peaked at $9 trillion or so. Then we've had a drawdown since then, but we are obviously reaching the point where we are getting close to another economic crisis. And the next round of QE is going to be more significant. You notice that the rounds of QE, they grow over time because you have to have bigger and bigger interventions by the very nature of the system. One of the reasons this is such a problem, though, is that in previous rounds, you had the rest of the world sitting there ready to buy up this U.S. debt. You had the Fed buying the debt via QE, but also the rest of the world was there to absorb the excesses. But as you can see on this chart, the percentage of U.S. Treasuries held by foreign entities peaked back in 2008, around 40%. It's been declining ever since. Now, that isn't necessarily because countries stopped buying U.S. debt. They just haven't been able to keep up with the rate of borrowing. And so even though they've continued to buy, there has been so much borrowing that the percentage held by foreigners has been on the decline. But now we've entered into this phase where the geopolitical climate is so negative and the trade war situation has other countries so worried about holding U.S. treasuries and U.S. dollars. And also you've had war with Russia, where we had their assets seized, their dollar-denominated assets flat out seized and given to their geopolitical rival. They're given the interest from those assets to Ukraine to fund a war against them. I mean, this should be a huge warning sign to any country holding large amounts of U.S. treasuries, like China, for example, that may find themselves geopolitically in the wrong alignment relative to the U.S. And so they're going to be very concerned about holding this. So, we've got de-dollarization. They're flocking into what? They're flocking into gold. That's why the gold price has been soaring, but they don't want U.S. treasuries. So this time around, when federal spending ramps up to bail out the economy, because deficits don't shrink during recessions, they tend to expand because the government tries to spend more money to stimulate the ailing economy, the Fed is going to be the only buyer. So you're going to see the Fed balance sheet really explode here. And that is going to have a very negative impact on the purchasing power of the US dollar, this wave of debt monetization, which is likely ahead. I mean, we've already got Donald Trump calling for lower rates and more stimulus from the Federal Reserve. What's that going to turn into when there's a real economic crisis? This is a chart of the US dollar index, which you can see has fallen below the $100 level for the first time since 2023, when it briefly dipped below that level. But this $100 level, which is illustrated by this yellow line, has been a floor for the US dollar index for several years now. And we have now penetrated below that meaningfully. And if the Federal Reserve does in fact return to quantitative easing, the rest of the world's not going to be there to buy up all of the debt coming out of the Treasury. It's just going to be the Fed. You're going to see the value of the US dollar plummet. From a technical standpoint, it's not looking very good on this chart, and the fundamentals also support a lower dollar moving forward. And while institutions like central banks do see the writing on the wall, they're buying up gold like there's no tomorrow, retail investors seem to be oblivious to this risk, despite the fact that it's staring us right in the face. And I think that the setup here with silver, again, when we go to this long-term chart and this cup and handle pattern, a breakout from this pattern, similar to the one that we saw in gold last year, is likely to coincide with this crisis. And that's when you're going to see silver rip above $50. Once you're above 50, there really will be no resistance. And I wouldn't be surprised if we see a similar move to what we saw in gold. That's just my interpretation. I guess you should bookmark this video. We can come back and look at it in a few years and see if that does in fact play out. But it seems to me that the writing is on the wall here for the dollar and for the precious metals. And while gold, I think, is still a good buy at $3,300, not financial advice, of course, silver is ridiculously cheap at these prices. Right now, the gold to silver ratio is over 100, which suggests historically that the metals, even though gold is near record all-time highs, are still very cheap and have a long way to go. Silver is going to have a lot of catching up to do once it finally breaks out of this pattern. So leave me a comment down below to let me know what you think. If you enjoyed this video, make sure you check out the one that's popping up on your screen right now. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker out.